I was trying to interpret what you were saying. It was a detailed presentation, but you talked about how AI is now worth paying for. You talked about the end or not of Moore's law, depending on your point of view, but the need to scale to meet demand. Was that you saying we are not in an AI bubble?
I don't believe we're in an AI bubble. And the reason for that is we're going through a natural transition from an old computing model based on general purpose computing to accelerated computing. We also know that AI has now become good enough because of reasoning capability, research capabilities, its ability to think. It's now generating tokens and now generating intelligence that's worth paying for, to the point where I'm paying lots of it. Cursor is all over NVIDIA. Every single one of our engineers use it. We pay lots and lots of money for it, and we're delighted to do it. And Cursor is just one of the applications. You know, what is it? 11 Tech, I forget. But anyways, all of these different AI models that we're using, we're using plenty of services and paying happily doing it.
Justin Hotard, the Nokia CEO, Jensen Huang, NVIDIA CEO, and our host here in Washington, D.C. Thank you both very much. Back to you.
And of course, the AI trade remains the primary trade. Ed Lillo in Washington, D.C. for NVIDIA's GTC conference. I'm Romain Bostic here in our Studio 2 headquarters in New York.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S., just about an hour away. You can see we have a rally and then some on our hands. If we take a look at where markets stand, the S&P 500 up by about 0.4%. You can see that a lot of that strength is coming through in the S&P 500, higher by about 0.8% right now. And then you take a look down the list as well. The 10-year Treasury yield, we are well below that 4% level now, firmly there, but pretty well behaved, as you can see, Romain.
6,900 on the S&P 500, and you could thank big tech for that. You could thank AI, and you go back to 2 years and 11 months ago when OpenAI was unleashed to the public here, and that has now become the trade for financial markets. We got a good taste of that today, a barrage of headlines on fresh investments out there. NVIDIA taking a $1 billion equity stake in Nokia, Microsoft securing 27% ownership in OpenAI, Blackstone partnering with Saudi Arabia's Humane, PayPal embedding its digital wallet inside ChatGPT, Sequoia leading an investment in Rogo, TeraWulf in a joint venture with FluidStack, the U.S. government backing an $80 billion nuclear reactor build-out by Westinghouse. And that was just what was announced today. NVIDIA CEO Jensen Huang on stage at his GTC conference saying the AI industry is just getting started.
We have a big partnership with Nokia. Nokia is the second largest telecommunications maker in the world. It's a $3 trillion industry. Infrastructure is hundreds of billions of dollars. There are millions of base stations around the world. If we could partner, we could build on top of this incredible new technology, fundamentally based on accelerated computing and AI, and for the United States, for America to be at the center of the next revolution in 6G.
And somewhat fitting that he gives that keynote address in Washington, because to put a finer point on it, business investment in computers and other processing equipment, it accounted for 1.3 of the 1.6 percentage points of real U.S. GDP growth in the first half, and more than 50% of the S&P's point gains this year attributable to just 6 of the 500 members in that index. NVIDIA, of course, has been the primary winner, going from a $300 billion company just 3 years ago to $5 trillion today. Microsoft, Amazon, Alphabet also lifted to eye-popping valuations over that stretch. And then there's privately held OpenAI, which is now paving the way to morph into a for-profit and potentially publicly traded enterprise. A lot going on today, Katie, in the AI space.
Absolutely. And let's keep that conversation going now with Bloomberg Intelligence Senior Analyst of Technology, Anurag Rana. He says that Microsoft keeping OpenAI's intellectual property rights for both products and models through 2032 stands out in today's revised agreements. I'm pleased to say Anurag joins us now. So we'll get to the restructuring, Anurag, but let's just talk about what this means for Microsoft. Of course, they're also entitled to receive 20% of OpenAI's revenue. That's staying as well. Put this into context. What exactly does this mean for Microsoft?
See, when you look at Microsoft's products right now, the various Copilot products, they primarily run OpenAI models. So whether it's GitHub Copilot or the Microsoft Copilot, they're selling quite a bit in the market. But they don't have their own frontier model that's doing so well in the analysis. There are 3 models that are doing pretty well right now: Google's Gemini, Anthropic models, and OpenAI models. So them basically securing those models up to 2032 is something good, because let's assume that they can figure out their own models by that time. So they're not going to have a disruption in their products that they're selling to public.
There's been a lot of talk about this idea of Microsoft giving up that right of first refusal, the idea effectively that OpenAI can now more or less be free to strike deals with anyone else that it wishes. Do you anticipate that?
Yeah, see, frankly speaking, that was already, there was a soft yes, always, because OpenAI first initially only on Microsoft Azure. Then they got, you could say, permission to work with CoreWeave. Then they worked with Oracle. So Microsoft was already, in that camp, because they don't have the capacity to take care of all of OpenAI needs. So it was allowing OpenAI to go outside. So that is something that's not troublesome for me. But the one thing is going to be fun to see is, does OpenAI go to AWS now? Because so far they have not done that. And OpenAI, as you know, AWS is the one vendor where we have not seen growth spike up. And the big question is whether OpenAI will go and knock on their door now.
Anurag, Rana with Bloomberg Intelligence, a nice breakdown of that deal. Microsoft striking a 27% ownership stake, potentially paving the way for OpenAI to turn into a for-profit and potentially a publicly traded company. AI is the talk of the town on Wall Street and in D.C. Jensen Huang just off of his keynote address on the GTC stage. But we should point out, this is a multi-day conference. It's been going on for a couple of days, and it continues tomorrow. U.S. Representative Sam Liccardo, who represents the 16th District of California, which includes the heart of Silicon Valley. He's going to be on a panel to discuss AI's future in America and the innovation agenda. I'm pleased to say that Representative Liccardo joins us right now. And Congressman, there's been a lot of talk about the AI build-out. I feel like if we had this conversation a couple years ago, we would have just been talking about private companies or companies, I should say, investing in this space. Over the last few months, we've seen the U.S. government take a huge role in facilitating investments, facilitating partnerships, and potentially facilitating our AI future. Are you in sync with that?
Well, Ramin, good to be with you. I feel that first, we do need to be leaning in. Frankly, what we've seen from the federal government and frankly from Congress for too many years has been really a lack of engagement. And we think about policy changes that have been long overdue, whether it's around a data privacy policy or updating social media in Section 230, a whole host of areas where we simply haven't been acting and engaging. And we are seeing engagement now. Now, I can certainly pick plenty of areas where I would disagree with the president's direction, but we do need to be leaning in on AI. And certainly the government needs to be using AI itself. There are plenty of ways in which we can be more efficient, more responsive to our customers, that is, the citizens of our country. And I think there are plenty of us who are recognizing this opportunity for us to improve how government functions.
I am curious, particularly in your seat in Congress, and obviously prior to that, you were mayor of San Jose. You're basically in the heart of, at least for what in the U.S. is the tech industry. What are you hearing from a lot of the business leaders out there in terms of what they want from the government in terms of assistance and guidance in this AI build-out?
Well, I think, I'd give credit to President Trump with respect to the fact that he is engaging. And, bluntly, as a Democrat, I'm frustrated, as many of my own constituents were, often that we didn't have a White House that was engaging in tech quite as much. Now, how they're engaging is problematic. And as we think about actions from this administration around a whole host of issues from tariffs to immigration, there's a lot of deep concern in Silicon Valley. And look, innovative economies thrive on one basic principle, which is openness. We need openness to people. We need openness to new markets. We need openness to technology. We need openness to new ideas. And there is deep concern about this administration's assault on universities, on its actions on immigration and a whole host of areas, including H-1B visas, and tariffs with very complex supply chains, as so many tech companies have. And so there's a lot of very deep concern about the actions of this administration. And I think there are plenty of folks that would wish that this was a federal government that was not as deeply engaged.
Well, Representative, I want to follow up on that conversation about openness with the idea that the chip industry, in particular the semiconductor industry, has really been in the crosshairs of a lot of these trade negotiations happening between the U.S. and China. For the U.S., that has been sort of situated as a national security concern, and that has been given as justification for why Chinese access to some of this U.S. technology, U.S. chips in particular, has been limited. There's the competing school of thought that by limiting access of the Chinese market, that basically you're allowing homegrown Chinese companies to fill that void and become really powerful competitors. And given that, you are speaking tomorrow on U.S. technological leadership, I wonder where you fall on that debate.
Well, I certainly understand the national security concerns around, for example, enabling the most advanced Blackwell chips to be used in China. But as we look at some of the recent changes, for example, in export controls around H20 chips or chips that AMD was looking to sell there, I think we need to have frankly, a more forward-leaning approach around trade and trust that we are going to win this race as long as we are more innovative than our competitors, and particularly China. And that means, yes, we need to let go of some of these export controls, which are constraining our ability to ensure that the best American technology becomes the technology that's used globally. And we think particularly around AI, it's not just NVIDIA's chips that need to be used throughout the world, but the software, the entire technology stack. And if Huawei supplants NVIDIA in China and elsewhere as the dominant provider, then we have a much bigger national security problem on our hands. And so, again, openness is the key here. And I would side with those who would say, yes, we need to relax some of these export restrictions within reason.
Well, I also want to bring in, of course, what you mentioned when it comes to H-1B visas here into that conversation, because when it comes to innovation, a lot of that comes back to your workforce. And of course, if we're allowing fewer of these visas, I have to imagine that's a taller hurdle.
It's very problematic. Look, Jensen Huang is one of about half, is an example, about half of our venture-funded startups and tech companies are led by a foreign-born founder. We need to attract the best and the brightest in the world. The H-1B visa program is one of those great sources. There are others, and there's no question that we can reform the visa program in many ways to ensure that it's not being exploited, to ensure that the visas might be portable so that some employers are not simply using them to depress wages, et cetera. But the reality is this is an essential element of the innovation economy. And we need to be doing more immigration, not less. And as we think about the impacts on our universities and our research and development centers, the idea of keeping the best and the brightest out of our country is simply going to be counterproductive.
All right, Representative, great to get some time with you. Really appreciate it. That is Representative Sam Liccardo, a Democrat representing California's 16th District. Meanwhile, NVIDIA's $1 billion investment in Nokia to pivot into artificial intelligence, it's just the latest in a string of AI deals that have raised concerns about circular financing and increasing debt loads that are contingent on this massive build-out actually bearing fruit. Joining us to discuss is Nisha Patel. She is SMA Fixed Income Portfolio Manager over at Parametric. Great to see you in person.
Good to see you, too.
So let's talk about this a little bit more. We've raised this stat on the program before that if you take a look at the investment grade corporate credit market right now, there's more debt that's tied to AI than there is to financials. And I keep coming back to that. So basically, if you see companies relying more on debt, tapping the debt markets to basically fund this build out, I wonder what that means for the world of fixed income investing and how specifically investing in tech changes.
Yeah, I think the messaging is a little bit more the same that you might be hearing a little bit on the equity side, right? I mean, are we at the beginning of this AI boom, or are we a little bit in the later cycle? And so when you talk about AI names, it's really going to be dependent upon the actual companies themselves, what the plans are for these capital investments, and then more importantly, you have so much priced into credit spreads today, right? It's priced to perfection, as the market experts would say. So now that may be fine here in an environment where the economy still looks very resilient, right? We see a lot more momentum for growth with some of these specific companies, but there's a little bit of a cautionary tone that we're taking, right? And that all comes down to individual idiosyncratic type of credits, and you really want to be staying ahead of that. For our clients at Parametric, where capital preservation is key, that may mean, right, underweighting possibly some of these sectors that have run a little bit too much, and then possibly, kind of evening that out across financials, where that typically has been more resilient in these types of economic cycles.
Well, to focus a little bit more on spread, it has been amazing to see the resilience there. We stay at these very, very tight levels, and for a lot of folks, the question comes down to, do I care more that spreads are very tight right now? You could say that's very expensively priced, or you could look at the all-in yields and say that looks okay, and it sounds like maybe you lean more towards those expensive valuation concerns.
It's a combination of both, but I would say in this environment where I think credit spreads are where they should be, right, with looking at the overall tone of the economy, looking at recent earnings, I then go to the latter point of saying yields are still high from a historical perspective, right? So when you go back to from an asset allocation perspective, you take a look at, where we are in terms of absolute yields. Fed possibly continuing their rate cutting cycle, right? And we can certainly speak to that. That reinvestment risk of sitting in cash has become very high over the past few months, right? And that could continue. So for fixed income investors, as you think about stepping out of cash, fixed income, right, especially in the investment grade space, again, you don't have to take a lot of credit risk to earn a decent amount of yield. I think that's what we're really telling our clients to, it's about the carry trade, right, given where yields are today.
I am curious about that, and I guess let's just go there. I mean, we kind of got overshadowed today by the big Jensen Huang event, was that the Fed actually did start their two-day meeting today here. I know we're not expecting any real surprises tomorrow, but you seem to suggest that if people are going to come out of cash, is that a bet, the idea that interest rates are going to continue to drop? And I mean, beyond just tomorrow's decision.
Yes, so I'm looking for two things tomorrow. So I think, look, as we've maybe discussed ad nauseum, I think the 25 basis point cut is priced in, but I'm looking for what the Fed has leaned on to really say, okay, here's a 25 basis point cut. We really are focusing on the labor side of things. Again, you're going into this a little bit blind with limited data, based off of surveys, based off of business sentiment. They still might be focusing on that overarching job weakness, labor market aspect instead of inflation. Now, the second thing I'm looking for is really the guidance, right? As you go into December, that starts to get trickier as the bar seems a little bit higher for now to possibly continue to cut. However, what I'm suggesting is it's a pause rather than an outright, right, we could be paused for an extended period of time, I think going into Q1, if you see a little bit of the economic steam, kind of the steam come of the economy a little bit, you have a lot of the maybe risk on sentiment come off a little bit. You do start to see more tariff impacts. You do see a little bit more layoffs. We also, in some headlines, have been seeing major companies, right, with significant amount of layoffs. That could start really taking more momentum, not for the right reasons in Q1.
Just real quickly here, the balance sheet. Everyone wants to know whether Jay Powell is actually going to address this issue of whether they are going to maybe end quantitative tightening or at least taper it down a little bit?
Yes. Yeah. So that's another thing I'm looking out for tomorrow. And so I would say with the Fed that has really been a little bit more dovish, a little bit more cautious. We're starting to see some signals in the funding markets that are showing a little bit of stress, right? Not an outright crisis, but it seems to me that this would be a good time for them to at least indicate that they're going to pause, right? They're going to consider ending this, and this would be a good time to line that up. Inserting liquidity back into the market certainly is a good thing, and it would also, I think, solidify the fact that the Fed wants to stay ahead of the curve and is ready to do what's necessary before we have another funding crisis like we did in 2019.
All right, well, maybe we'll find out tomorrow. Nisha Patel, portfolio manager over at Parametric here. A lot to cover on the close today, including that Fed meeting, including all the talk about AI and, well, earnings. One of the best performers in the market today, it's not NVIDIA, it's UPS, delivering on earnings and maybe potentially delivering on that turnaround plan. A discussion when we come back after the break. This is The Close on Bloomberg. All right, one of the worst performing stocks of the year is one of the best performing stocks of the day. It's UPS. The share is up about 7% after smashing Wall Street's profit estimates by reducing costs and cutting 34,000 jobs. Ariel Rosa joins us right now, senior analyst of equity research at Citi. He's at a buy rating on the stock. All right, there's been a lot of discussion right now about why UPS has not been able to get its mojo back. We knew that there were cost-cutting efforts in place. We learned today that those cost-cutting efforts seem to have been supercharged in a big way. You see the pop in the stock today. Do you think that carries beyond today?
Yeah, absolutely. I mean, you look over the longer term, and the stock is really down quite a lot, right? I mean, it's been cut in half since kind of the COVID period. And so there's a lot of work still to do on cost cutting, certainly. And there have been some surprises. In fairness to UPS, right? There have been some kind of unique challenges this year, we might say, right, around tariffs and other things, and economic weakness or sluggishness that they've had to contend with. And then in the process of that, of course, they've been trying to reduce their exposure to Amazon and build up their exposure with kind of the SMB segment and the healthcare segment, which is higher margin, but it takes time to kind of orient that shift. And then they also have to cut resources to adjust for that different volume environment. So there are a lot of things to do here.
I mean, how much time are you willing to give Carol Tomei and her management team to pull this off?
Well, certainly, I think the timeline has been extended with today's earnings. And so it's clear that they have some positive momentum, right? And I think that's what the stock's positive reaction is today. I'll tell you, kind of looking at our broader transports universe, I think UPS was one of the most out of favor stocks. And maybe this brings some people back back to the table.
Yeah, certainly. I mean, looking at the share reaction today, it seems like someone was brought back to the table. But talk us through, of course, the end of this year as we get into holiday season. That was why a lot of eyeballs were on this company and this report as we head into that crucial period. I mean, looking through the numbers today, listening to the earnings call, in your view, how is this company set up?
So fourth quarter is always the most important quarter of the year for UPS, right? Not surprisingly, with kind of the peak season and the holidays. We're going to get a really good read on how's the consumer doing, how much demand is there for kind of holiday shopping. UPS benefits from there's actually one more day in the holiday period this year, and so that actually should help kind of smooth out demand. Also,
so you're saying I have extra time to shop?
You have a little extra time to shop, absolutely. And frankly, with some of this momentum they have around efficiency initiatives, that was another thing that I didn't touch on just yet, but they talked on the earnings call, they talked quite a lot about using technology and leveraging technology to really kind of streamline operations and drive efficiencies. And therein also you get some cost savings, right? And through, frankly, reduced headcount.
And I do think it's interesting that I take a look at your stable of coverage. You cover UPS. You also cover FedEx, and these two are often put against each other, which is what I'm going to do right now because both are underwater year to date. But it seems like just in the past few months, FedEx has managed to pull ahead. Would you expect now with this this better than feared report, if you want to call it that, from UPS, that we'll start to see that gap narrow?
Yeah, absolutely. So it's interesting because historically, always UPS has traded at a premium to FedEx, and that gap absolutely had been narrowing over the past year or two. FedEx has been executing well. I think both companies, frankly, have these kind of big transformation initiatives underway. Thinking back to the COVID period, right, there was this huge surge in demand. They've really struggled to kind of adjust resources down after building up resources for that COVID period. And, these are both big, large organizations, global organizations, and so it's difficult to adjust that resource base, but very clearly they're in the process of doing it, and both FedEx and UPS have kind of major initiatives underway in terms of kind of resource utilization.
I mean, how do you sort of grade UPS, and for that matter, FedEx too, for that matter, with regards to how they're handling the tariff issue? It seems like there's been a certain opaqueness to this, and I know the last time that we spoke with Carol Tomei on this program, they talked a lot about this idea of trying to find ways to work with their shippers, with the folks shipping those packages, to understand the tariff dynamics so that consumers aren't surprised on the back end when their package shows up and, they have to pay a little bit extra on the tariff side.
Yeah, so frankly, I mean, in terms of a grade, it would probably be an incomplete at this point, right? And so, look, it's a real challenge for them. And you have to almost be a little bit sympathetic to them because this environment where policy seems to change really frequently. And, even to date, we still don't know really what the tariff rates are going to be. And I think a lot of businesses are sitting on their hands waiting to find some clarity around those things. What they are doing in the interim is being proactive, right? And so one of the things they talked about is, for instance, customs clearance, where earlier this year, they were doing that it was a very manual process. They talked about now 90% of custom clearances are done automatically. And so they're clearly making progress, but I think we still need to wait to see kind of where the tariff rates settle out and how businesses respond.
All right, Ariel, great to get some time with you on the heels of these UPS earnings. That is Ariel Rosa. He is Senior Analyst of Equity Research over at Citi. UPS shares up 7.5%. Now, coming up, Schwab's latest survey on trader sentiment is out.
What does it say?
I'll tell you. We're going to discuss all the findings with the man in charge, Charles Schwab's head of trading services, next. This is The Close on Bloomberg.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld. The NASDAQ 100 at session highs right now, which brings us to Schwab's latest trader sentiment survey, out with some new findings on the sectors that investors are most bullish about, Romaine. And at the top, tech, big surprise.
Yeah, I had asked you this before the break, and you refused. There's a deep tease there, but I guess we all know that tech would be at the top.
Yeah.
Actually, not too much of a surprise, the other two, right? Energy and utilities, which to a large extent pretty much ties into the one at the top of the screen.
Right, the Venn diagram, there's a lot of overlap there between those three sectors. So here to discuss is one of the experts behind that report, James Kostulias. He is Charles Schwab's head of trading services. James, great to have you in person.
Thanks so much for having me, Katie. It's great to be here.
So let's talk, of course, about tech, because that is the positioning, right? That folks are really excited and bulled up when it comes to the tech sector. This is the fourth quarter survey that you have out. But how long has tech basically been in the limelight here?
Pretty much the whole time, Katie. And so this is the second consecutive survey where we've seen bullishness at record levels, at 7% of our clients, of traders, actually bullish. But tech's remained at the top for a while, but it's a little bit of a nuanced story, to be honest. They're bullish, but they're cautious, right? And so there is a sense, roughly 2/3 of those surveyed said that they think the market's a bit overvalued. And so what we are seeing in tech is long a lot of the names you would think of in your Mag 7 and your AI trades, but cautiously long. So hedging some of those positions with options as examples, and maybe taking some off when we see big pops in stocks, and then returning to those positions a little bit when we see dips.
That's really interesting. I mean, there is the notion out there that when the music is playing, you have to dance. And hearing you talk, it sounds like that's sort of the mindset that you're describing of some of the folks that you surveyed.
Yeah, I think they want to be participating, right? They see overall a longer-term bullishness, but maybe in some cases they're using options as a stock replacement strategy, right? Because if, in fact, the market is a bit overvalued, I'm actually taking risk off the table with an options position as opposed to an equity one. And then to your point, which I thought was a really good one, Romaine, around sort of utilities and energy sort of driving tech and the AI trade, we are seeing a little bit more, especially in crypto, of clients looking at sort of some of the less household names in the pure play crypto space. So maybe something like an IREN as opposed to a MicroStrategy, where they're looking a little bit away from their straight crypto play and into more of the mining or the data center or the energy providing space, which is interesting too.
Yeah, and it's kind of interesting too. At that NVIDIA event, they announced sort of a slew of agreements with a wide variety of companies, from Lilly to Nokia, et cetera, et cetera. So you get a sense here that that trade is broadening out a little bit, at least the opportunities there. I am curious though, outside of tech specifically, are you seeing any bullishness in any other sectors?
Yeah, so we saw a little bit of bullishness in healthcare. I think partially because it was just beaten up for so long, and that gets back to the retail investor and the retail trader being a little bit more conscious of opportunities as stocks have been beaten down. We also saw a pretty crowded trade in metals last quarter. Interestingly enough, as they've started to get beaten up a little bit over the course of the last few days, we've seen our clients, including younger clients, which I thought was interesting, younger clients getting more into metals. You don't typically sort of think of that, but our clients have been actually net sellers 4 out of the last 6 days in the metal space, getting maybe a little bit ahead of some of the selling that's gone. But I think it's also consistent with that idea of I'm bullish, but I'm a little bit cautious. So maybe I'm allocating some of my powder towards metals, which I think may be a little bit less volatile.
In terms of the risk, though, I mean, what do they see as the big risk? Is it, I don't know, geopolitics? Is it the Fed? What?
Yeah, stagflation is definitely one as they look at sort of the labor market and some of the risks. So it does some of these tie together as well, just like you had said before. But stagflation's high there. Government policy, and I think that's reflected in both the shutdown. We're at day 28, but we haven't really seen much of an impact. But I think at some point people think there's got to be some impact at some point, right? And then I think still some of the government concern rests around some of the concern about tariffs and still some of the volatility like we saw where, it was kind of quiet for a while. And then on the 10th of October, we had a little bit of noise, and that feeds into some of the pockets of volatility that we've seen.
Right. That's really interesting because, just keeping up with the headlines is pretty exhausting. So it sort of feeds into the backdrop that you're describing that, okay, people want to participate, but they're a little bit cautious. And as we go forward here, I'm just curious about, these results that you just got for this survey. How does that compare to where we started the year, for example, because the tariff picture, for example, has changed dramatically since then.
Absolutely. So the two major things that I've seen different, we've been bullish for a while, but again, we're at the most bullish levels that we've been. That notion of overvalued has gone up a lot. So it's gone up 10 percentage points since the last survey, from about 57 to 67%. So I think people are definitely fearing a little bit of the overvaluation. The other thing that jumped out to me was confidence level. We heard 70% of those surveyed are confident in their ability to make good investment decisions. We think that seems a little bit incongruent if you're cautiously bullish, but I think it's a factor of people leaning into education. We lean into a lot of education at Schwab relative to the derivatives markets and broad basics of stock trading and things like that. And so as they consume more education, they feel more competent. They feel a bit more confident in what they're trading. And seeing that number at 70% was new to me. That's an all-time high as well.
When you look at the data, do you get a sense that the buyers are making very individual idiosyncratic decisions about the stocks to buy, or is this more of a just, shoot your shot at the sector that's hot right now and go along for the ride?
I think we see good concentration in the ETFs, right? And so if you're believing in the sector, you want to be in the ETFs. So we absolutely see that. We see concentration in names for sure. One of the things we see, though, that's really interesting is sort of the contrarian perspective that some of our clients take. I mentioned October 10th and October 13th. October 10th is one of the biggest down days we've seen in a while. That was our biggest net buy day for our clients in a really long time. And then we actually saw the converse on the 13th, where we saw a pretty big net selling day. So I think it is a combination of they want to be in the sectors. They also want to be in specific names, but not when they see those names as overvalued, where they're either getting out of those positions to maybe get back in at a little bit lower, or at a minimum hedging some of those positions.
And we should just point out, those were back-to-back sessions, the Friday.
That was a Friday and a Monday.
3% drop, and then the 2%.
So that is, those are some engaged clients that you have on the platform. Quickly, before we let you go, when you mentioned that you're seeing more folks basically use options to hedge, so are they using actual contracts, or are they going into, for example, some of these options-based ETFs, which basically promise to do it for you?
Yeah, it's a lot of straight options trading for us. And so we're up roughly 40% September over September year over year in terms of contract volumes. We're also seeing more of our new traders and our experienced traders get into the more complex option trades. And so what that tells me is it's sort of less of some of the just risk-on leverage strategies, and it's more risk management strategies that we're starting to see. But it's definitely a lot of pure options trading, Katie.
All right, really fascinating report here, and just a wealth of data and information out of James Kostulias, Charles Schwab's head of trading services, on a day where we see the Dow, the S&P, and the NASDAQ at session highs and record highs here on the day, driven by what else? Big tech. And there's a lot of activity going underneath the surface, and it's not just involving AI. Shares of Qorvo soaring, along with Skyworks. Skyworks set to buy its fellow Apple supplier. It's our stock of the hour, and it's up next, right here on The Close on Bloomberg. All right, well, Apple is set to report earnings on Thursday, but two of its biggest suppliers, there are stocks of the hour right now. Qorvo shares surging on the heels of a deal announcement with fellow Apple supplier Skyworks Solutions. Skyworks agreeing to buy Qorvo in a cash and stock deal for $22 billion in enterprise value as Apple's transition to its own homegrown chips forces these companies maybe to seek other options. Bloomberg's Norah Mulinda joins us right now to talk a little bit more about this. A big day for both companies, but I'm a little more concerned about what their future is. So their concern is, we're talking about both of these companies get like more than half their revenue from Apple. We should just point that out right now. By combining, does that help them?
I mean, I think you're seeing a lot of these companies wanting to scale. It's a really unpredictable environment. There's a lot of innovation happening. So for a lot of these companies, it makes more sense to combine forces. As you called out, both of their revenues are pretty much hinged on Apple. So if they're now running toward their own homegrown suppliers, you have to figure out alternatives and still remaining relevant for your customer base and just being able to diversify and expand. And that's what you're seeing being done here.
Yeah, it's interesting to see shares of both companies higher by about 7% today, maybe suggesting that the market thinks this is a good idea. But will the government, could this run into any regulatory hurdles?
And that's the question that people are starting to talk about on Wall Street. I mean, we are seeing more and more consolidations happening. There's been a ton of deals just mentioned in the tech space today alone. So it is about the conversation about whether or not it may be a bit more scrutiny coming from the government, hammering down on these companies as they're really just trying to be nimble, really, and try to figure out how they can still remain a major player, not only in the race here in the U.S., but also on a global scale here.
And this also gets to the idea, too. I mean, we've been talking all day about AI, and neither one of these companies really has AI attached to them. I know they're kind of in that universe, but we're talking about pretty basic types of chips. I mean, complex, but basic relative to what we're seeing with AI. Qorvo is like power systems, right? And Skyworks is more, I guess, on the connectivity here. Did they articulate any sort of plan to maybe try to make something a little bit more advanced, or is this just going deeper into the space that they're already in?
So it's definitely going deeper into the space that they already have, but it's also about whether or not they're going to be able to pay off on all the synergies that they are putting out there. So it's going to be a question of investors really looking closely to say, hey, these are what these two companies were doing separately. What are they able to do here as a team duo? And are they able to actually outpace a lot of their competitors as they continue to grow and evolve here?
And it'll be interesting to see what happens, what their strategy is, if we really do see that Apple revenue removed here. And to that point, Norah, I mean, do we have any sense of how far along Apple is when it comes to actually developing its own homegrown components to maybe cut out these sorts of players?
Well, that still remains to be seen here. I mean, as you mentioned, they are cutting out a lot of these competitors, and they're really having to go into their own personal avenues to figure out how they can still have a certain sense of relevancy here. But I mean, it is clearly a bet on Apple saying, hey, we are investing in ourselves and we're wanting to focus on ourselves. And the rest of the companies, I guess, kind of have to get with it or get left behind.
I have to, before we let you go, Norah, I do just have to ask you about overall about the rally that we're seeing. Another record high potentially today for the S&P and the NASDAQ. Now, we've got some huge earnings coming down the pike over the next, 48, 72 hours. I mean, Microsoft, Amazon, Meta, I know I'm forgetting a few others here. I mean, how much is the market dependent on that? I mean, when you're at record highs like this, I mean, you basically need perfection right now out of these companies, not only to come through with what the market expects, but almost to really come well above what the market expects.
Absolutely. And you're seeing a lot of the market heavily scrutinizing any company that's not really meeting the mark. And as it pertains to Wall Street's expectations, as you called out tech in particular, there's always a high bar that needs to be met. And we see investors continuing to raise that mark. Of course, we don't hear from NVIDIA for a little while. Of course, the AI darling of the market. Yeah. But as we look at a lot of the tech companies that are going to...
a lot today, though.
That's true.
Did you watch this thing? It was insane. It was literally like a 2-hour TV show.
It was a lot of headlines coming through.
Yeah. And I understood about like 10% of it.
Yeah, a lot of acronyms, I feel like. Norah, we're up against the clock. I have to leave
stack.
it.
The tech stack.
Reporting,
dominated.
As always, that is Bloomberg's Norah, Mulinda, of course. We're just about 15 minutes away from that market close. We'll drive you there with the private advisor from Rockefeller Global Family Office. This is the close on Bloomberg.
You have so much priced into credit spreads today, right? It's priced to perfection, as the market experts would say. So now that may be fine here in an environment where the economy still looks very resilient, right? We see a lot more momentum for growth with some of these specific companies, but there's a little bit of a cautionary tone that we're taking.
Nisha Patel over at Parametric kicking us off to the close just about 50 minutes ago here. A focus for her, of course, on the debt side of the AI trade. For the equity side of the AI trade, it's still going strong.
Yeah, absolutely. And I think it's funny to take her comments. There's so much priced into credit spreads. There's so much priced into this equity market. You can see the S&P 500 trying to hang on to its bid again. You can see a lot of that coming through in the NASDAQ 100, that big tech strength. And you can thank NVIDIA for that, higher by about 5%. 5% right now. Of course, we're coming off NVIDIA Day down in Washington, and it's really holding up this market before we get into the heart of this week, those big tech earnings and, of course, the Fed.
And I want to point out, I mean, even though this is a very narrow rally, only about 100 S&P stocks are in the green, it's a pretty diverse group. I mean, we talk about NVIDIA, but one of the best performers today we were talking about earlier is UPS.
Yeah.
You're also seeing a bid come into a Nucor, Sherwin-Williams, paint. Have you painted your house yet?
Absolutely. As you know, I'm renting right now. We haven't bought, so it's a painful subject. But yeah,
well,
UPS coming
is
out.
up 3%. You can buy a little, a blender or something for your spruce up your kitchen there or something.
I am allowed to have that in a rental. So.
Okay. All right. Well, that concludes the home improvement portion of the show. Meanwhile, back to markets. Angela Mwanza joins us right now, Managing Director and Private Advisor at Rockefeller Global Family Office. And Angela, I do want to start off with the AI trade. I mean, there's been, this has been the heavy lift for markets for really the last 3 years since ChatGPT kind of came into the public consciousness here. And I think everybody keeps looking at it and saying, when does this all come crashing down? Right. But everyone you talk to, when you ask, is this a bubble, you find very few people who are willing to say that at least right now, they see a bubble in the AI trade. Do you see one?
I don't necessarily see a bubble per se. If you think about what's the definition of a bubble, I think about, okay, well, we've got high valuation. Do I have high growth? And are there real fundamentals behind that growth? Look at all the cash flows. Look at the revenues. Even now, we're early on in earnings season. We're seeing over 80% of companies reporting are beating expectations, and by a pretty decent margin. So as long as we're seeing those fundamentals, as long as we're seeing that cash flow, those revenues, the earnings, it doesn't rhyme with the old 99, 2000, where everything was like gung-ho. But if you looked underneath the cover, it was a kind of like the little duck feet underneath and nothing really happening.
Do you see that trade, though, broadening out a little bit? We've been talking a lot about how for the last couple of years it was NVIDIA, Microsoft, a couple other big companies. But now you're seeing a lot of other sort of companies on the periphery that are, at least on the surface, appear to be benefiting from this trade as well in a variety of industries.
That's very true, Romain. Actually, I think most companies, about 80% of companies are saying that this adoption rate of AI has really precipitated, and it's being welcomed in regardless of the industry. I think what we're seeing also is that because there's been such a run-up of these tech names, of these AI-driven names, and we're kind of painting everything with a broad brush here. I mean, we're talking about whether it's cloud, we're talking about ad sales, we're talking all of these, the Mag 7. Each of these, the growth rate behind it is so huge that it's an outsized portion of our portfolios now. And so we're looking at this concentration risk. Yes, we believe in the AI story, and yes, it belongs in the portfolio and in our clients' books. But the concern now is having this huge, big outsized holding, and you have a very low cost basis. And so as we're going into year end and looking at planning with our clients and looking at our diversified portfolios, we're saying, how do we manage for the potential tax impact if we reduce that? But we definitely want to reduce that because we're concerned about the risk.
Absolutely. Well, I want to bring the Fed into this conversation because we do have a Fed decision tomorrow, that two-day meeting kicking off today. When you think about the direction of markets from here through the end of 2025, I mean, to boil it down to this week, which do you think is more important in determining that direction? Is it these big tech earnings that we're going to get, or is it what we hear from Jerome Powell tomorrow?
I think I don't expect there to be any surprises around what we hear from Federal Reserve Chair tomorrow. I think we're looking at 25 basis points tomorrow, probably another 25 basis points in December, and then Q1 maybe a third 25 basis points. What we are looking towards, may potentially shake markets, is who's going to actually take his place. We have 5 good contenders, and now the question is, how will the global markets react to who that pick is, and can they really reflect and show the market that they are truly independent?
Are you comfortable with all the names that have been floated out there publicly?
I mean, so far so good. Yeah. The proof is in the pudding, as they say. But I mean, there are 1 or 2 that I think are probably more likely, but I don't want to name names and mess all the betting pools out there.
Right, as prediction markets become a bigger and bigger force. So you're comfortable with the 5 candidates listed there. I mean, what do your client conversations sound around that? We have until May 2026 to sort of blueprint what the market reaction might look like. But we know that the decision for the president is coming sometime soon. Secretary Scott Bessent saying that he wants to get this list to the president within weeks now.
I mean, we're expecting some resolve towards the end of the year. We won't know till we get there. For us, we're really looking at how do we manage risk? How do we stay diversified? I'm very concerned about what's happening around tariffs. I'm, on the one hand, very happy to see U.S.-China relations de-escalating and hopefully coming towards a resolve. But inflation is still a concern that we're thinking about. We're looking at hedging. We like commodities. We like gold. We like silver. We're adding that to the portfolio. Still.
At these levels.
At these levels, because it takes a while for these tariffs to work their way through the system, and we're really just at the beginning of it. So we're talking about something that could have a multi-year impact, and we want to position ourselves in the right way for that.
Just real quickly, with regards to like this big trade that we've seen in like rare earths and these other sort of critical minerals, are you finding opportunity there, or is it too early?
I think it's still a little bit early. There are some interesting plays. A lot of them are in the private markets, so we'll have to wait and see on that. But we do love alternatives in general within the portfolio. We love that idiosyncratic risk. We think that things that are not highly correlated with what's happening in the AI world also have a good place in a portfolio.
All right, Angela, always a pleasure. Angela Mwanza, Managing Director and Private Advisor at Rockefeller Global Family Office, counting us down to the closing bells. Just about 3 minutes to go, Katie Greifeld. We are off the highs of the day. In fact, the S&P is now trading below its opening price, but still in the green, still at record highs. Similar story for the NASDAQ.
Yeah, all we need is for the color to be green, and that will be a fresh all-time high. I will say on the S&P 500, we did briefly...
I like these kind of days, because that way I don't have to do any math. I just look at the colors.
It just needs to be green. I will say we did break briefly above 69,000 or 6,900 rather on your S&P 500. We've come back below that, but for a lot of people, that's just a matter of time.
Speaking of numbers, you know, I sat across the table last night from this guy, his accountant, who was like a bit of a savant. Like
Your accountant?
Yeah, no, just some random accountant. I don't know, but I mean, you rattle off any number or anything, and he can just, you know, add and subtract.
Couldn't be me.
Do anything. Absolutely, we're going to do that for you. Katie's going to do it for you with our global simulcast now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostick here with Katie Greifeld, taking you through to that closing bell with a global simulcast. It starts now. Carol Masser and Tim Stenovic in the radio booth. Welcome to our audiences across all of our Bloomberg platforms, including our partnership with YouTube. And S&P 500 with only 108 names in the green, but that's good enough to push the entire index into the green and to a record high.
Isn't it amazing as we get ready for so many big earnings? And I feel like as we have conversations, there's still questions about the outlook out there. But having said that, you're right. We are on track for another record close here on Wall Street.
So what's the disconnect between what's happening out there in the economy and what's happening out there in the market? We just had Danielle DiMartino Booth on the program over at QI Research, and she said asset prices, they're surging despite the weakness that we're seeing in the labor market. It's a disconnect that the Fed is going to have to deal with at its policy meeting. We're going to hear from Fed Chair Jay Powell tomorrow.
Yeah, cannot wait. Of course, that meeting kicked off today, and it'll be interesting to hear him weigh in on the economy, some of the policymakers' views around that. As we are well aware, the government is still shut down. We're not getting any official updates, but even still, this central bank has to make policy amid all this fog.
But this has to be kind of a difficult one, right? Because we talk about financial conditions. I don't know what argument you can make the financial conditions are tight, given what we've seen, not only in equity markets, but in other asset classes as well. But then you overlay that with the labor market, where we're not getting official data. But how many sort of job cut announcements have we heard just in the last couple of weeks? I mean, tens of thousands of workers, and we're not even halfway through this earnings season.
No, it's a really good point, right? It's hard to ignore them, and it does feel like the momentum is building in terms of jobs being cut at companies remain.
I just want to point out, too, of course, NVIDIA has dominated the headlines all day long. We continue to get additional headlines out of Jensen Huang and the other folks at NVIDIA. An interesting one crossing the wire right now with Jensen Huang saying that the government has not offered to take a stake in the company. We're going to talk a little bit more about NVIDIA, which helps to lead the charge, pushing the S&P and the NASDAQ to record highs. The S&P up 16 points or 0.2%. The NASDAQ composite up 190 points or 0.8%. The Dow Jones Industrial Average up 160 points or 0.3%. While the Russell 2000, that's getting left out in the cold on the day, down 14 points or 0.5 percentage point.
All right, we do have some earnings crossing the wire right now. This coming from Booking Holdings here. And here are some of the headlines. Third quarter adjusted EBITDA coming in at $4.23 billion. That is a beat for Booking, at least on that line item. The estimate had been for $4 billion. Third quarter gross bookings coming in at $49.7 billion. That's also a beat of expectations that were just a hair below $48 billion. And the nights sold, when it comes to the third quarter, the room nights sold coming in at 323 million. That is also ahead of expectations. You can see the after hours trade, though, not too much reaction yet. We'll have to parse through that. But again, a beat when it comes to adjusted EBITDA.
All right, guys, let's, as we wait for some more earnings, just a couple of the big outperformers in today's session. PayPal at its highs up almost 13%, finishing the day with a gain of about 4%, a top gainer in both the S&P 500, NASDAQ 100. Company raising its full-year earnings guidance and announced a tie-up with OpenAI to embed its digital wallet into ChatGPT, sending its shares up the most in more than 6 months. So a big deal there. Nokia, speaking of deals, thank you very much, NVIDIA. We did see Nokia ADRs that trade in the U.S. soaring in today's session, up about 22%. NVIDIA planning to make a $1 billion equity investment in Nokia. That's, as we have reported out, kind of a vindication that Nokia's pivot from mobile networking kit into AI by the sector's kingmaker. I mean, listen, that is a big endorsement from NVIDIA for Nokia. And then UPS, just want to point that one out, up almost 8% in today's session, smashing Wall Street's profit expectations. The company cutting costs. They have been on that maneuver for a while. They cut 34,000 jobs this year, which goes to what Romain was talking about earlier about the job cuts that we are seeing at the company's closing owned buildings. It's all this cost-cutting initiative. They expect to achieve $3.5 billion in total year-over-year cost savings in this year alone. So investors liking that.
Can I just add an honorable mention? Wayfair, 23% jump today, Carol Massar. Highest, best day, I should point out, going back to January of 2023. I heard you had the CEO on earlier today, right? Or the CFO.
Yeah, Kate Gulliver joined us for an extended conversation. She was, look, this company absolutely surging this year. Remember, it's a marketplace, so they're not like actually seeing the they don't have the inventory.
Yeah.
They're a marketplace that connects buyers and sellers.
Yeah.
But she's saying, you know, she's optimistic. She's really optimistic, and she was obviously pleased with today's performance.
Yeah, I guess Carol Master's been buying a lot of pillows.
Yeah.
Yeah, she's not allowed to buy anymore.
No,
apparently.
I'm not allowed to.
Yeah.
My husband's like, there's no more room on the bed.
Okay.
Romain, thanks for watching.
Team Mr. Master there.
Thanks for watching the show, Romain.
I don't know what it is with you women and pillow. I got 38 pillows on my bed, and I'm only allowed to sleep on
just 38?
I'm always like, don't touch them, don't touch them.
I know. I was like, what? And the only one I'm allowed to touch is like the worst pillow. I don't know what's happening.
It's so true.
Okay, let's go to some of the decliners before we get some more earnings, guys.
How many pillows do you have, Katie?
I actually only have 4 on my bed, which is interesting.
All right, you got to step it up.
She's only been married a little bit, right? Like a few years
been married like 8 years.
Oh, well, come on, step up your game, girl.
All right, all right.
JetBlue shares falling close to 12% today. The company talked about the challenges that it would have through the holiday travel season, rising fuel prices, hurricane, a U.S. government shutdown. Executives, though, said demand for premium offerings is stronger compared with the main cabin as air travel rebounds. Investors, though, growing impatient with executives' ability to meet cost-cutting targets. Once again, JetBlue down about 12%. And then watching what happened with a couple gaming stocks today. DraftKings down 5.5%. Flutter Entertainment, it's the parent company of parent company of FanDuel, down 3%. Those companies extended a decline following a Bloomberg report that Polymarket is preparing to return to the U.S. in the coming weeks to focus on sports betting. But shares were already down because Trump Media and Technology said it plans to make prediction contracts available on its Truth Social network. That's called, or will be called, Truth Predict, which is interesting because there are other companies out there that do this, but they have relationships with the Trump family already, like Kalshi and Polymarket as well. So it's getting a little crowded when it comes to those predictions. And finally, VF Corp down 12.2%. Biggest intraday decline going back months. The North Face and Vans owner issued third quarter adjusted operating guidance that missed the consensus expectations. Shares once again down 12.2%.
All right, let's do a quick check on yields here. I mean, they actually went nowhere, but I really just want to use this as an excuse to remind everyone. Actually, a Fed meeting started today. I know everyone was focused about 15, 20 blocks away down in Washington, D.C., where Jensen Huang was giving that keynote address. But this is a pretty pivotal meeting, not so much as to what they do tomorrow, but what they telegraph here for the potential rate cuts that could be ahead for the rest of the year and into 2026 here. So a bit of a holding pattern as we wait for that decision. Let's go back to earnings right now with Mondelez crossing the wire right now. All your fan favorites there under that umbrella of the food company, including Oreos. Operating margin looks like it did come in above estimates. Adjusted EPS also looked like it came in above estimates. 73 cents a share. The street was looking for 71 cents a share. The revenue relatively in line with estimates at $9.74 billion. That's pretty much what the street was looking for there. Adjusted gross margin, though, coming in light, and that might be the reason why you're actually seeing the shares lower in the after-hours trade. 30% adjusted gross margin. The street was looking for about 33.1%, so almost a 3 percentage point difference here from what they reported and what the street was looking for.
All right, we got more earnings crossing. I want to start with EA reporting net bookings for the second quarter that missed the average analyst estimate. I don't know. The net bookings came in at $1.82 billion. The estimate was for $1.88 billion. Total net revenue at $1.84 billion. The estimate was for $1.81 billion. As you can imagine, we're not seeing shares move that much in the after hours, considering this transaction is in progress, but down about just ever so fractionally in the after hours.
All right, guys, let me just get to Frontier Communications. Stock up about 8% here in 2025. Frontier, third quarter revenue, slight beat, $1.55 billion. The estimate on the street was $1.54 billion. Third quarter adjusted EBITDA of $637 million. That too was some outperformance in terms of the number. $596.5 million was what the street was looking at for. Right now, that stock's unchanged. So we'll look for some more headlines on this one.
Yeah, let's also zoom in on Visa here, also reporting earnings. Their fourth quarter adjusted EPS beat estimates. That came in at $2.98. The estimate had been for $2.97, so a very slight beat there. And then you take a look at some of the other headlines coming through. Fourth quarter net revenue came in at $10.7 billion. Again, slightly ahead of estimates, which were for about $10.6 billion. So very slight beats overall. You can see that the stock, not too much direction right now, down slightly in after hours trade to the tune of about 1% right now.
Let's take a look at Enphase, the solar company whose stock was down almost 50% year to date coming in today, now moving lower in the after hours trade. For the third quarter, adjusted EPS did beat 90 cents a share. The street was looking for 65 cents on average. Revenue, though, in the quarter also beat $410 million. The street was looking for 364. Here's your guidance, though. The company says that for the fourth quarter, revenue will be in a range of $310 to $350 million. The top end of that range is well below the average of street estimates for $381 million. That does appear to be why you're seeing some weakness in the shares.
Yep, continuing to be down about 1.5% here in the aftermarket. All right, folks, that is a wrap. Our cross-platform on radio, TV, YouTube, Bloomberg Originals. Katie and Romaine continuing there on the close on BTV, and Tim and I continuing right here on radio on Bloomberg Business Week Daily. We will see you again, same time, same place, tomorrow.
And our coverage continues here on Bloomberg Television, a breakdown of the earnings we get today, and more importantly, a push ahead to the slew of earnings out of the Mag 7 over the next couple of days. Tech, the driving force in today's market action. It's been the driving force all year long. Will that continue? That conversation coming up after the break. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostic. You might get tired of me saying this, but another record day on Wall Street. Katie Greifeld with the Dow Jones Industrial Average, the NASDAQ indices, as well as the S&P 500, all stretching to another record high on the day. Fractional gains, to be sure, powered largely by what else? The AI trade. We saw big tech moving higher once again here on the back of optimism about the continued spend in the AI trade, and more importantly, the potential for that trade to actually broaden out. We're going to get back to that story in a second, but we should point out there were a lot of things left out of the trade today. A lot of the cyclical stocks and a lot of the industrial stocks did not participate in this rally. That Russell 2000 down about 0.5% on the day. And gold, spot gold, doing something that it hasn't done in 3 months, and that's fall, Katie. for 3 straight days.
And Romain, just for the record, I will never get tired of all-time highs. It gives us something to talk about. Let's talk about, though, Royal Caribbean not exactly joining in on the action, delivering a pretty muted fourth quarter forecast. You can see it sent shares down by 8.5% on the day. I also wanted to highlight PayPal beating on EPS, also announcing a partnership with OpenAI on a very busy day for OpenAI, which I'll get to in a moment. And then you have NVIDIA shares higher by about 5% on the day. And that brings us to our top story this hour, AI fueling earnings optimism. Microsoft getting a 27% ownership stake in OpenAI, NVIDIA investing $1 billion in Nokia, Apple briefly joining the $4 trillion club. This as 5 of the Magnificent 7 get set to report results over the next 2 days, with Microsoft, Alphabet, Amazon, and Meta projected to post a combined $360 billion in CapEx in their current fiscal years. Meanwhile, you also have NVIDIA CEO Jensen Huang saying we're not in an AI bubble.
I don't believe we're in an AI bubble. And the reason for that is we're going through a natural transition from an old computing model based on general purpose computing to accelerated computing. We also know that AI has now become good enough because of reasoning capability, research capabilities, its ability to think. It's now generating tokens and now generating intelligence that's worth paying for.
Jensen Huang on the sidelines of his big conference in Washington, D.C. today. Our next guest, he doesn't cover NVIDIA, but he covers a lot of the companies doing business with NVIDIA. Aaron Kessler is internet analyst at Seaport Research Partners, covers Meta, Alphabet, and Amazon, among several other companies. And Aaron, I do want to start off with the spin. I mean, we're going to get results out of those 3 companies that I just mentioned. And obviously, less important for a lot of investors are going to be the bottom line results. And more importantly, the CapEx spend, whether that goes up into next year. Are you expecting that?
Yeah, no, definitely expecting double-digit increases in CapEx. Come out and say they're going to increase that by roughly $30 billion, I believe, in 2026, a pretty big increase for Meta. We expect pretty solid increases from Google and Amazon as well, really driven by their hyperscaler spend on the CapEx side. We think they're seeing strong demand, but particularly Google seeing strong demand for their AI initiatives. And so that's, we think, supportive of strong CapEx spend, the demand that they're seeing from customers as well.
Now, you take a look at these 3 companies. There obviously are a lot of similarities, but as I'm sure you know, they're also very distinctly different companies with what I would presume are distinctly different goals with regards to how they're going to use AI and deploy AI, et cetera, et cetera. Is there sort of one in that basket, Aaron, that you look to and think is maybe a little bit more ahead of the pack than the others?
Yeah, we think Google's probably benefiting the most right now from AI, both on its Google Cloud platform, as well as leveraging AI for advertising as well. Meta clearly is also seeing the benefits of AI for advertising, but less clear in terms of their super intelligence initiatives, what type of long-term ROI they'll see from those investments. And Amazon, we think they probably lost a little bit of share on the cloud side for AI. Still think they'll get their fair share, but I think that's the key focus for investors on Amazon call. We do expect good retail spending, good advertising on Amazon, but investors are going to want to see what that AWS growth rate is. I think investors want to see a high teens growth acceleration to around a high teens growth rate for AWS.
Well, let's zoom out, Aaron, and talk about ROI more broadly, because there was an interesting note from Matt Mealy over at Miller Tabak this morning saying that the one issue which might create some headwinds in the continued lack of ROI for these hyperscalers, for their massive investments in AI. This was definitely a narrative a couple of quarters ago that you saw investor patience wearing thin when it came to that ROI. It feels like that's been on the back burner, but do you think that that question could come back this round?
Yeah, we don't think that's a near-term concern probably for Google or Amazon, because we think they're seeing the strong demand, and that's why they're spending the CapEx. We think we have heard that concern on Meta just in terms of the long-term ROI for their kind of super intelligence spend, and less of a clear ROI at this point for Meta on the kind of the non-advertising AI spend. But I would say for Google as well as for Amazon, they're seeing the strong demand on the hyperscale of the cloud side, and that's supportive of their increasing their CapEx at this point.
And Aaron, when it comes specifically to Amazon, what are you expecting to see when it comes to the cloud business? You remember that AWS outage from a couple weeks ago? That was one in several things that folks had sort of flagged as a concern when it comes to the AWS business overall. So what are your expectations there?
Yeah, I'd say less concerned on the outage, but investors do want to see an acceleration in the AWS growth rate to a high teens, probably 18, 19, 20% growth in the quarter, and the outlook for Q4. The general investor views that they've been losing some share on the AI side for cloud spend, and so we want to hear more commentary from Amazon as well on the AI spend, not just overall cloud spend.
I am curious, particularly when it comes to Meta, Aaron, this idea of maybe this sort of AI evolution now moving into actual devices. Obviously, there's been a lot of talk about the new glasses that Meta is going to deploy, and I know there's some other products out there that have been rumored, if you will. Do you think that could be a viable business? Because I know Meta's gone down this road before with hardware, and well, we know how that has turned out.
Right. I think the hardware is still a little bit to be determined. I guess the question is, are these mass market products? We are more positive, I would say, on the glasses versus the VR side, but still a bit early there. Clearly, Meta is investing across a number of different areas outside of the core advertising business. We want to see, I think WhatsApp still has good potential. So near term, I would say it's really still about their advertising potential. Longer term, definitely has some option value in some of these other areas, including hardware.
All right, Aaron, great to get a preview with you. That is Aaron Kessler. He is internet analyst over at Seaport Research Partners, looking ahead to some of the earnings tomorrow. But Romain, we have plenty of earnings right now. Yeah, let's take a look at Caesars, the big casino operator, coming in with revenue in the most recent quarter of $2.87 billion, just a smidge below what the street was looking for at about $2.89. EBITDA, $884 million. That was a big miss. The street on average was looking for about $940 million here. Now, the company does talk a little bit here about some of the performance, particularly in Vegas, which is its biggest market here. And you did see a little bit better strength there, though we should point out the numbers for Las Vegas specifically on a like-for-like basis was below average, the average of street estimates, $952 million. The street was basically looking for about $1 billion even. Yeah, there's been a lot of questions about the future of Las Vegas outside of just that specific earnings report. But let's get over to the Cheesecake Factory, ticker Cake, which is just perfect. They reported adjusted earnings per share for the third quarter that actually beat the average analyst estimate, 68 cents versus the estimate of 60 cents. So a beat there. Their revenue came in a little bit lighter than expectations. So too did restaurant comp sales. They said that the performance was led by the Cheesecake Factory restaurants. They do own other franchises as well, but it was their flagship that really drove the numbers in the quarter. That was. This is the close on Bloomberg. Well, shares of Electronic Arts, they actually fell slightly in the session. They're a little bit higher in the after hours. That's after the video game maker behind hits like The Sims and Madden NFL reported results just moments ago. This as Amazon is making significant cuts in their video game division. For more on the broader video game sector, let's go to Michael Pachter. He is Managing Director of Equity Research over at Wedbush Securities. Great to have you with us. Let's go straight to those EA results. They reported again just after the close now. So you've only had a few minutes to look at them, but they reported lower sales and profit in the fiscal second quarter. They had some tough comparisons versus a year earlier, and I just wonder what you make overall in this first blush.
It's all about Battlefield. So, the second quarter is the sell-in of their soccer game. They used to call it FIFA. It's now EA Sports Football Club. So it really is up to how many units they actually ship. And since everything's digital now, they can't stuff the channel. So it begs the question, when they miss, who cares? Battlefield came out in October, so the next quarter, and Battlefield is setting records. So they're absolutely fine. And the stock is trading on the acquisition price anyway. Nobody except maybe the Saudis care what they earn.
Yeah, well, to that point, I mean, the company also said that it wouldn't hold an earnings conference call or issue its forward-looking guidance because of that pending transaction, Michael. So you sound confident that this is a deal that's going to get done.
Yeah, the deal is structured to avoid it looking like the Saudis are acquiring EA. So the Saudis brought in Jared Kushner, who helps them politically, and then Silver Lake, who helps them as a private equity firm. They're structuring it as a leveraged buyout. It is absolutely not that. They're just trying to make it look like the Saudis aren't buying a U.S. business. They very clearly will take Silver Lake and Kushner out in a few years and pay down the debt. The Saudis are absolutely buying EA, and our government's going to say nothing about it, nor should they. I mean, I don't think that it really matters. You can't actually do anything. You can't take the IP away. So yeah, the Saudis are getting in the video game business. So I think that's actually good for the industry because they have kind of bottomless wealth, $913 billion in the public investment fund. So they can really beef EA up if they choose to. And I think EA was kind of ready for change.
Well, when you say if they choose to, I mean, also, Michael, I mean, I'm sure, you know this, obviously, from your years of covering this industry, is just this idea of how difficult it is to have a successful game, or particularly a big game franchise. And we were talking a little bit earlier on this program about Amazon scaling back some of the personnel in its video game unit. I don't think we have enough time in the show to list the number of flops that came out of that unit. What is the secret sauce, if anyone has it out there, to sort of have the next big thing?
Yeah, there is a secret sauce. And full disclosure, my firm is raising capital for a new venture, a lot of capital, to try a new way of making video games. And these guys are kind of turning everything upside down. They're going to seed 50 studios with 5-person teams and give them $500,000 each, and have the 50 studios, in 6 months to a year, come up with 50 separate game ideas. Then they're going to pick 10 and invest 10 million more and have them, staff up to 30 or 40 people. And then they're going to pick 3 winners and publish them. They're going to probably put another 30 million in. That's the way to do it. That is not the old school way. That's not how Amazon does it. That's not how EA does it. So a flop costs you $250 to $500 million. My client is going to actually fund probably about 50 ideas for a total of a couple of $100 million. So out of 50 ideas, they're hopeful they'll get 3 great games at a fraction of the normal cost. EA is old school. Amazon built their whole business on old school. They don't have any innovation in that company on the game side.
I'm curious, too, also just about the idea of the platforms maybe becoming a little bit less important as they were. There was a lot of hay made earlier this week about Halo finally being offered outside of the Xbox ecosystem here. Do you see us kind of moving in that direction where these games are going to be platform agnostic?
Okay, I'm going to ask you a very unserious question. Do you remember movie theaters, and then do you remember DVDs and renting them?
Yes.
And now, now if you want to watch a movie, you can actually tune on your phone and flick it to your TV screen. That's where games are going. So connected TV is the answer. There's one company that actually knows this and another that's trying. It's Microsoft who knows this, and Netflix who's trying to get into it. Come back in 5 years and talk to me, and we're all going to be playing games on our connected TVs without any device. That's coming. And so absolutely, that's why the new video game development model matters. You have to do it cheaply. You have to do it distributed across a whole bunch of different people so you come up with great ideas. So our client is actually doing that.
All right, Michael, well, we're going to talk to you a lot sooner than in 5 years. Always appreciate you taking time for us. Michael Pachter, Managing Director of Equity Research over at Wedbush Securities. As we continue our focus here on the close, on the state of markets and the state of the economy, with the Fed meeting underway and a big decision tomorrow. Former Fed Governor Betsy Duke, former Fed President Ester George. Join us after the break.
If inflation is still 7,500 basis points over target, you want to really scrutinize what's going on in the labor market, because do you really want to get to neutral with inflation this much above target? I think right now they're trading this off and saying, listen, we've got to guard against a weakening in labor. I would agree with that, and I would cut in October too. But beyond October, even though the market thinks it's a done deal for December, in my mind, if I were in my former job, I'd really want to be vigilant about it.
Former Dallas Fed President Robert Kaplan urging vigilance on the part of the Fed once we're past tomorrow's widely expected rate cut. Our next guest spent years practicing Fed vigilance, including in the face of the great financial crisis. Former Fed Governor and former Wells Fargo Chair Betsy Duke joins us right now. Talk a little bit more about the meeting that, quite frankly, Betsy, we've been joking, got kind of overshadowed today by all the talk about AI and NVIDIA. But as the market sort of turns back to the Fed decision tomorrow, and more importantly, the idea of what vigilance even looks like when you have a market at record highs, yet you have a lot of evidence that there is some sort of crack in the economy, particularly on the labor market side.
So I think there are a couple of things that are making things particularly murky for the Fed right now. Certainly there's the lack of specific data because of the government shutdown. But the other thing is it's hard to tease out the effect of monetary policy currently because there are so many other policies that are affecting the economy in a much stronger way. So you had fiscal policy in the Great Big Beautiful Bill, you have the shutdown, you have tariffs, you have immigration, you have deportations, you have a lot of uncertainty and unpredictability in terms of policy. And I think all of those are affecting the economy so strongly that it's hard to tell how much you have eased or not on monetary policy.
So this gets to the question, though, is that how do you even assess in the here and now, as they're behind closed doors, where financial conditions are? I mean, I've heard the argument that financial conditions might be tight. I don't know. I look at a stock market and other price action in the public sphere. Seems pretty loose to me.
I don't see anything to indicate that financial conditions are tight, nor do I see anything to indicate that monetary policy has been so tight that it's really pulled down inflation much over the last year.
Well, Betsy, I mean, what do you make of the arguments that we're not easing here, we're just getting back to neutral? It sounds like, again, maybe it's not in a restrictive place, but certainly folks would argue that we're higher than neutral is right now.
Well, so I think you have a lot of different estimates of what neutral is, and you are actually, if the cut comes tomorrow, you will be into the highest estimate of neutral on the FOMC right now. So I think you could argue that it's not that far from neutral and very hard to tell where you're going. And to me, that would argue going very cautiously and very slowly.
Absolutely. So if that is, your view here, that's how you would proceed, cautiously and slowly, what do you think is motivating the consensus in markets that we're going to get at least 2 more Fed cuts this year? October, tomorrow seems like a done deal. And then the expectations are that we're going to get that other 25 basis point cut come December right now. I mean, what do you think belies that confidence in markets?
Well, so if I were on the board, it's exactly that confidence that would really be worrying me right now. And I think I would likely be a dissent at this meeting. I would likely vote against this move, not necessarily because I think this move by itself is that impactful, but setting up this expectation that you're going to move a quarter point at every meeting. Once you build that momentum, particularly if you follow it with a cut in December, I think it gets very hard to stop the momentum in market expectations. So I would look for at least 1 dissent tomorrow.
I do have to ask you about the balance sheet, Betsy. I mean, you were on the Fed board. I believe you joined just maybe a few months before we started quantitative easing, and we've had, 4 iterations of that. A lot of talk right now about the quantitative tightening and whether the Fed went too far with that and whether they should, in some way or another, either end it or maybe start to pull back on it just a little bit.
So again, it's hard to tell what the balance sheet is doing. They're looking at really short-term market conditions and looking at their ability to control market rates to the area where they want them. And I think the size of the Fed's balance sheet is a problem altogether. And I don't know how the Fed gets out of the business of adjusting its balance sheet to ease money market conditions. As the fiscal debt grows, that's going to become more and more of a problem.
I am just curious, Betsy, but back in those days, and particularly when you talk about in the financial crisis, was there meaningful discussion about an exit plan?
Well, that was a whole lot of the discussion, and I was against QE3, and I was against open-ended purchases for exactly that reason. And a lot of my concerns had to do with how did we get out of it. I can remember asking Chairman Bernanke as we were going into it, why is this not monetization of the debt? And he said, it's because it's temporary and it's for a different purpose. Well, it certainly hasn't been temporary, and now it's a significant part of the Fed's normal operations.
All right, Betsy, really great to get some time with you ahead of that big decision. That is former Fed Governor Betsy Duke. Now to another former Fed member who dissented at her first 7 FOMC meetings in favor of tighter monetary policy. Former Kansas City Fed President Ester warns that last Friday's CPI release, it may require the Fed to reassess the upside risks to inflation after tomorrow's near certain rate cut. I'm pleased to say that Ester joins us now. Great to have you with us. So clearly, you're no stranger to standing outside of consensus. As we just discussed, the consensus is that we're going to get a rate cut tomorrow, and then we're going to get another rate cut come December. If you held your previous seat, if you were on the Fed today, how would you be voting when you take a look, especially at where inflation is right now?
Well, I think going back to the September meeting, the real question is monetary policy too tight, and is bringing it down the answer to what we've seen in the economy related to a labor market that has normalized, I would argue, and an inflation rate that has persisted well above target for a number of years now. And I think for me, while the committee has leaned in the direction of the labor market, I think they risk ignoring what is really a key part of their mandate, and that is keeping the inflation rate at their target. So I think there's more work to do as opposed to just looking at bringing that interest rate down.
It's interesting to hear you say that. There was a note in my inbox this morning saying that 3% is the new 2%, of course, a reference to the Fed's inflation target. And do you think, I mean, just looking at their actions, looking at the public commentary coming out of the FOMC members, that 2%, that target has become less of a priority for them?
Well, the committee has reaffirmed 2% as their target through their framework review, as you know. But your actions speak louder than your words, as you suggest here. And I think that's something to keep a close eye on, is whether the committee will continue to lean in the direction of trying to support the labor market when we are at a 4.3% unemployment rate, a pretty low unemployment rate, and an elevated inflation rate. And I think that's the real tension here that the committee is going to have to resolve sooner rather than later.
I know we're kind of operating, at least for the last 4 weeks, in the absence of data and maybe that potential of official government data, I should say, and maybe that continues for a little bit longer. But we've already started to hear from a lot of companies that have reported job cuts and at least plans for job cuts. And I am curious as to how quickly does the Fed react to those types of disclosures, or do they just wait for the actual official government data to reflect those job losses?
Yeah, it's a good question because obviously the Fed is very committed to its dual mandate, and it takes signal from the labor market to read what is happening in the broader economy over the long term. Obviously, that affects your outlook for GDP. You're trying to understand the demand implications of that. And so it's an important indicator for sure. But I would just point back to today's unemployment rate relative to where we were a couple of years ago can look higher. It can look like the job market is worse. What the Fed is really trying to gauge, and again, this is a tough environment when you have cross currents of major policies in play, of judging what that outlook is going to be. And that, of course, is why they're paying particular attention to the labor market. I think that's right to keep an eye on that. But by the same token, their most direct impact does come through their inflation ability, their inflation reduction ability through the Fed funds rate.
Well, when we talk about inflation reduction, and I won't sort of kick a horse while it's down and talk about the fact that we've been above target now for going on 4 years, but this idea that the tariff impact, assuming that it is real, a lot of people think that it will start to materialize in a much more meaningful way over the next few months and quarters ahead. And so I do wonder if that puts them in a bind as well. If they do start lowering rates or easing overall and with regards to policy, does that leave us more vulnerable to an inflation shock, or I guess the impact of an inflation shock?
Yeah, I think it certainly does, Romaine. And again, you've heard the Fed chairman say there's risk either way we go. The problem is when you have an inflation target and you have upside risk to that inflation and you are looking at factors coming into next year, you've named one of them. How will companies continue to think about what tariffs mean to their bottom line, what they can pass on, what they can't? But there are other factors in play. We have easy financial conditions right now, in my view. We have fiscal policy that is providing more stimulus to the economy. And so those are the kinds of things I think the committee also has to be balancing very carefully to maintain their credibility And at the end of the day, to make sure that the public and the market's expectations for future inflation are going to stay anchored around their 2% target.
Esther, always appreciate it. Former Kansas City Fed President Ester George there as we await a big Fed decision tomorrow. And just a reminder, 1:30 p.m. Washington time, team surveillance will have special coverage of that decision. Bloomberg Economics anticipating, Katie, a 25 basis point cut in the federal funds rate, but more importantly, an announcement that runoff in Treasury securities from the balance sheet will actually conclude next month.
Absolutely. And of course, as always, it's the press conference where things could get really interesting. So looking forward to that tomorrow. But let's talk about some of the notable movers in after hours trading today. A lot of earnings crossing in just the past 40 minutes or so. You can see Caesars now down 7.7%. Visa faring slightly better here. Mondelez, though, I'm excited to talk about Mondelez.
Yeah, let's do that. Because I thought the earnings were interesting, but they talk a lot in there about cocoa prices, which of course are at astronomical highs.
Absolutely.
Yeah.
Think about the volatility, too.
Yeah.
They did say that their trimmed outlook was due to those high cocoa prices eroding performance, though the CEO did say that the third quarter represents the peak costs of the year. Still, shares down about 4%. And cheesecake, your outperformer here in the after hours, up about 1.2%. This is the close on Bloomberg. President Donald Trump unveiling trade agreements with Malaysia and Cambodia ahead of his meeting with China's Xi Jinping on Thursday. Now, tariffs, of course, set to be a major topic of conversation between the two nations. And our next guest will be closely watching for updates on the trade front. Now, the last time he joined us, he said that 87% of Christmas decor comes from China. And Matt Harman joins us now. He's the CEO of Balsam Hill, one of the biggest retailers of artificial Christmas trees and holiday decor. Matt, great to see you in person.
Thanks. Great to be here.
So I wasn't yet on this show when you last joined the close. So when that 87% figure was announced in our morning meeting, I was shocked to hear that. So is that still the case, or have we seen sort of a shift away from that reliance on China?
So it's still the case. I think we're going to see that number come down at the end of the year once the government reopens and numbers are reported again. But for us, everything we sell, 99% of everything Balsam Hill sells in the U.S. is imported. And so we've been working really hard to diversify our supply chain. We understand the president wants to rebalance trade, level things with China. But when you have 99% of your goods imported, it's a challenge. We think we're going to end up with a little over 60% of our goods coming in from China this year. So a big change for us. And that's something that we're doing, trying to support diversification, tweaking our supply chain. We don't know that these products are going to come back to the U.S. because there's so much manual labor involved in them, but we are able to diversify that supply chain, and it's just going to take years to do that.
Years to do that. And it's interesting, you know, in our discussions around China, we spent a lot of time talking about the non-tariff issues at stake when you think about soybeans and other products. But I would imagine from where you're sitting, you're keenly focused specifically on those tariff levels, which it seems like often they're used as a negotiating tactic and they change all the time. That must be difficult from the seat that you're sitting in.
Yeah, it is definitely a challenge for us. We are constantly adjusting that supply chain. I think last time I was on the show, we suggested that the government consider a 90-day pause on China, which they did a week later, which really helped us. We were able to bring a lot of goods in to try and keep those tariff costs down. And that's our main lever, is how do we bring things in at the lowest rates possible. We do know that the president loves Christmas, and you know, he campaigned on bringing Christmas back, and so we are hopeful that we'll see a change there. In 2019, he actually delayed implementation of tariffs and specifically cited the reason of helping Christmas. So we are hopeful that one of those changes that you referenced will be a lower rate, at least specific for Christmas goods. So we'll see.
The tariff costs, or the increased tariff costs, have you basically shouldered that yourself, or have you been able to pass on some of that to your consumer?
We've shouldered as much as we can, mostly through kind of when we brought goods in at lower rates, but we have had to raise prices some in the U.S. just to cover that, just because we didn't have any other choices. Unfortunately for us, our competitors are big box retail stores that either have a domestically sourced grocery business, a domestic lumber business, and so they have more options to eat the tariffs and spread things out. But for us, everything we have is imported, but we've tried to keep that as low as we can this year.
There's been a lot of talk about just the legality of these tariffs and sort of the IEEPA provisions that the president used to impose them. Assuming that we do get a court decision that does rule them illegal or not being collected in the proper way, are you anticipating that you might actually see a refund?
Well, I hope so. I mean, we've been offered by financial firms we can sell our futures on the refunds and get 20, 25 cents on the dollar. So we hope we would see that back. I think the thing that's interesting about this is I actually think the president's going to win either way, depending on which way the Supreme Court goes, because if the court upholds the lower court decisions and those refunds come back, the economy is going to have $250 billion coming into it that's going to go back to American businesses. That's going to trickle through the economy, and I think it's actually going to lift everything. And then the president's going to be able to impose tariffs through 232s and 301s and still get those tariffs in place, but with this economic win behind us. So we'll see how it turns out. The hearings are next week, but I think it's going to be a win either way for the White House. But if that decision came out and a refund were announced before Thanksgiving, before Black Friday, for retailers like us, that would be a huge boom.
Well, on that topic, let's talk about how the holiday spending season is shaping up. Of course, it's the 28th of October. We're not even through Halloween yet, but obviously for someone such as yourself, it starts way before then.
Yeah, we start selling in July. That's kind of our kickoff, and then it's this slow ramp up until this weekend. Once you get past Halloween, everyone kind of takes those spider webs down quickly and those witches and whatever, and they go right to buy Christmas decor. And so we're expecting to see a boost. Things have been a little soft this year in the U.S. market, really strong outside the U.S. And I think consumers are just waiting for that right deal, that right sale. We can see them as an online retailer put things in their cart and leave it there a little bit longer. And then as that sale hour timer clicks down, they come through with a sale. So I think it's going to be a strong year, but we're going to have to wait and see in the next couple weeks.
Do you think you're going to have to offer more discounts in order to get some of those sales to the door?
I don't know that. I think we have, Christmas is a declining good, right? Like it's not an expiring good in that it spoils, but the closer you get to Christmas, the more the discounts are. So it depends on supply and demand. Most retailers cut back what they brought in this year, and so I'm not sure we'll see as many discounts because there's fewer units to sell.
Yeah, I mean, Christmas is big. I mean, we're big on all holidays, so we're cycling through decoration. I always have this image of you that your house must just be all in Christmas gear, like 365 days a year.
I do my best. It's such a busy time of year for me before, so and my kids expect, that I'm the one doing it.
That's a lot of pressure.
Dad, this is your job. So,
all right, Mac. Well, it's always great to talk to you. Really illuminating, just kind of about the state of things right now, and of course, who doesn't love Christmas?
That's true.
All right, Mac Harman there. He is the CEO and founder of Balsam Hill. All right, when we come back, we're going to set you up for what the markets will have their eyes on over the next 24 hours. Stick with us. This is Bloomberg. All right, Hurricane Melissa made landfall in the country of Jamaica earlier today as a Category 5 with sustained winds of 185 miles an hour, about 298 kilometers per hour. Joining us right now to discuss the potential economic impact is Matthew Palazola of Bloomberg Intelligence, who covers insurance companies. And I know it's still too early to know exactly what the scale of damage is, but given that this does appear to be the strongest hurricane to make landfall in Jamaica, I would assume the cost is going to be high.
Yeah, I mean, so it's pretty rare to see a Category 5 hurricane make landfall anywhere in the Atlantic, so this is a pretty rare event. What we're going to see is, I would say, high single-digit billions in economic losses, but I do think there's going to be a wide gap between economic losses and insured losses.
And how potentially does that stack up to some of the other natural disasters, some of the other hurricanes that we've seen in the past couple of years?
It would be, in terms of insured losses, a pretty mild event. And we've seen hurricane losses up to 50 billion insured losses, which means that could be like 100 billion of economic losses. So this would be much smaller than a U.S. landfall hurricane.
Just real quickly, do we have any sense as to whether this hurricane might actually hit other nations as well that might actually have material costs too?
Yeah, I mean, probably not in terms of insured losses. It's going to hit Cuba after Jamaica, but we're not going to see anything in the U.S. It might also hit Bermuda a little further up.
All right, Matt, we'll keep a close eye on this story. I know you will as well. That is Matthew Palazola of Bloomberg Intelligence. Meanwhile, Romain, a busy day coming tomorrow.
Yeah, it was a busy day yesterday. It was a busy day today, and tomorrow is going to be even busier. A lot of earnings, of course, to parse as we are in the busiest week for earnings season. And we start before the bell, including from a big healthcare name.
Absolutely. CVS towing the line. We'll hear from them. We'll also hear from Verizon, Caterpillar, Etsy before the bell. And then aftermarket is where things get really explosive.
Yeah, I mean, this gets back to the AI trade that we've been talking about all day. Microsoft, Alphabet, Meta, each scheduled to report after the bell tomorrow. And of course, everyone wants to know how much are they spending on the AI build out, and is that going to continue to go up?
And of course, what's the ROI is, and if it's not, available right now, what is it projected to be? We also, of course, get an update from Starbucks, Chipotle, ServiceNow, eBay. So a lot of different industries covered. And of course, the Federal Reserve, I heard they have a decision coming tomorrow at 2 p.m.
Yeah, the Fed decision tomorrow starting at 2 p.m. with the press release, and of course 2:30 p.m. with Jay Powell taking the mic. Our coverage, though, starts at 1:30 p.m. Team surveillance. That includes John Farrow, Tom Keene.
Right.
Really nice guy.
Yeah.
Wears the bow ties.
Yeah, I've heard of him.
Yeah, so they're going to be doing all the whole breakdown, the pregame show, if you will.
The pregame, and then maybe a little bit after. And then we come on, and that'll be great.
Oh, absolutely. Thanks for joining us today here on The Close. We'll be back tomorrow. Stick around. Balance Power is up next, right here on Bloomberg.